We want to understand why, right? The zones work and how the zones are formed. So the whole idea of supply and demand and the whole idea of the strategy is based on the concept that we are piggybacking off the big banks and institutions, right? Because what moves the market is yes, trades, orders, buys and sells, but who moves the market is important because who moves the market, right? Or who has the power to move the market is the banks and institutions, right? So, the small people like us, we don't really have a drastic effect on the market. For example, to move the price from this point right here to this point up here, the only thing that could do that is millions of dollars, right? And how the market works is if a bank places a trade here for 100,000 lots, right? Now, from the moment that the bank places the trade for 100,000 lots, doesn't mean in order to buy 100,000 lots, there needs to be 100,000 lots available for sale, right? No, majority of the times, whenever a bank has to enter the market, they have to enter their trades piece by piece. So yeah, they might buy 100,000 lots of gold at this price, but if there isn't 100,000 people willing to sell, the price would move up, and let's say only half of their orders would get filled, and that would means that there's still 50,000 lots available to buy. I mean, that still wants to be bought at this price. So basically, once the bank places a trade and the market moves, we're expecting that the entire trade was not entered at the price. So once the market gets back to that price, the rest of the orders is going to get filled. So essentially, we're entering on the second touch of a move that's already begun, right? So that's kind of the concept, but in this diagram, what I explain is basically, just a bit of understanding of the zone, and this will just take 5 minutes. But basically, these supply and demand zones are simply imbalances of buy and sell orders in the market. What that means is the market is always at three places, right? It's either at supply, where there's more sellers than buyers, as reflected in the graph, and which causes the price to go down, or it's at demand, where there's more buyers than sellers, which causes the price to go up, right? Essentially, this is how the banks trade. They want to sell at retail prices, what they determine as a retail price for a profit, or they want to buy at a discount, a wholesale price, right? So that they could later sell at a retail price, right? Now, the banks, they buy and sell majority of the time at supply and demand zones. The retail traders, the novice traders, the regular guys like us, or anybody out there without large amounts of money, they mostly trade in the middle of supply and demand, what we call the novice space, what we recognize there isn't a significant supply and demand imbalance, right? And this is where the price spends 90% of its time. So just looking at these blocks right here, right? Whenever the price is high, right, at supply, we have little buying, right? Because the price is high. Only a fool buys when the price is already high, right? Now, because the price is high. You want to sell when the price is high. So usually whenever the price is high, you would have at supply, you would have more sellers than buyers, which would cause the price to go down, right? The price wants to spend most of its time in the middle, what we call the novice space. In the middle, there's equal number of buyers and sellers, which causes the price to go sideways, right? Now at demand, there is more buyers than there are sellers, which causes the price to go up. So our job is to simply identify these imbalances, basically the turning points in price, and enter with the banks, right? Now, it's key to understand that the price may spend only 5% of its time at supply or demand and 90% of its time in the middle. So in the middle, it would be wiki, it could go either direction in the middle, it consolidates in the middle, but at supply or demand zones, that's where the price would turn, right? And the market doesn't spend a lot of time there. So that's why once we enter a trade at supply and demand, the we wouldn't be in drawdown for a long time. The market usually touches the zone and leaves, right? So this would be an example. We have we have four types of zones, right? We have the rally, the base, and the rally, right? What this is, basically, once the market pauses or consolidates, that is the market being at an equilibrium, right? This once the market goes sideways, we understand that there's equal number of buyers and sellers. Now, once the market pops out of that move with a strong impulsive move, that signals to us that at this level there is an imbalance. At this level, there are more buyers than sellers, right? There's more demand at that price, which signals to us that, okay, if the market gets back down to this level, we will have a level at which there is more buyers than sellers. We expect there to be more buyers than sellers to cause the market to react, right? Now, all of this is kind of based on how the zone is created determines the quality of the zone, right? And where the zone is created is also more important than how the zone is, right? So our job is to just identify the imbalances in the market and trade off of them, right? So if we just look at gold in this example, what we could identify, we have a rally, right? A base for 2 candles. This is the hour time frame. 2 to 6 candles is the correct amount. The less amount of candles, the better the zone, right? But at minimum 2 to 6 candles. So we have a rally, right? A base and a rally, right? Now, the move away from the zone is important because the move away has to be at least 2 to 3 times the size of the zone, right? So this zone, let's say this is 1, the move away needs to be at least 2 times the size of the base, right? And that determines whether or not it's qualified. Now, once that happens, okay, we determine this is a demand zone. Now, you could identify the novice area, right? This is the middle. The novice area is where there's a lack of significant supply and demand, right? So you could look at the market and identify, okay, this is demand, this is supply, and this is a lack of supply and demand. This is the retail area. This is the novice area. This is where you want to stay away because you don't have a significant edge. Because there is so much buying and selling in the middle, the probability of having an edge is lowered because you want to, obviously you want to trade with your big brother. You want to trade where you know the banks are trading, right? Where you know there's more buyers than sellers and more sellers than buyers. But when you trade in the middle where there is relatively equal buyers and sellers, you can't really, it's difficult. So we identify demand, right? We could have identified supply. Supply is probably somewhere up here. And then we identify the novice. You want to identify the area where you don't want to trade. That is key because most people only identify the areas where they want to trade, but you also have to identify the areas where you don't want to trade, right? And that is the novice area. That is where you take unnecessary losses. So in this example is a rally-based rally, right? With consolidation, the novice area. So here we would just place our buy limit where we know there's more buyers than sellers, right? And then we would place our stop loss below in this example, right? So you can see how this trade worked out. And sometimes you need patience because this trade was identified on the 20th and it activated like a week later, right? And that's the thing with supply and demand. Most of the times, you would be able to identify your trades far in advance, right? You never need to feel rushed. So this is an example of a rally-based rally, right? With consolidation above, and then you buy at demand, right? But we know there's four different types of supply and demand zones. There's rally, base, rally, right? And then you buy at the demand. There's the same thing, drop, base, drop, and then you sell at supply, right? These are continuation, mostly continuation with the trend, right? So if you have a market that is trending up, so in this example, this market was probably trending up, and you want to get in on the trend, then you wait for the pullback to get in on the trend. And then we have rally, base, no, rally, base, and then drop, right? So this example is more of a reversal. So like for example, right here, you have something. This is not a good example, but this is what I mean, right? You would have a rally base drop, and this would be a supply, and then you would enter here to continue down, right? That right there is for reversals. So this is another example before we get back on the charts. And you have to train your eyes to identify this. You have the rally, right? You have the base, same two candles. And then you have the rally, right? And then now we have the novice area, the consolidation, right? Wiki, it's obvious that this is the novice area, just how the market is structured. It's going sideways, it's consolidating. And one pro tip, you don't want to use zones inside the novice area. So for example, right here, you had a rally, base rally. Okay, we'll go over that, right? And JA, you could ask your questions so everybody can see it instead of directly, right? But someone asked, how to know which time frames to look at, and we'll go over that for sure. But you want to avoid zones that is in the novice area, right? So you see how this zone right here, you look to the left, there's no consolidation. But this zone right here, you look to the left, there's consolidation. That's why this zone didn't work out, because this zone is inside of an area where there's a lack of a supply and demand imbalance. Basically, inside of this area, there's equal buying and selling going on. So there's no imbalance of buyers or sellers. But in this area, there's way more buyers. And I also color, sometimes you could get zones to work inside these areas. but it depends on the context of the market, and that's a whole other lesson. But normally the best zones are outside of consolidation, and normally I would highlight them yellow. A lot of the times, all of my zones are color coded based on the quality of the zone, and the yellow zones are like the highest quality, right? Because they're outside of the range. So you can see how this worked out, and that's just an example. But if you go over all the signals, right? If you go over all the signals that I send, all of them are based on this, concept. But obviously, there's a lot of other things to take into consideration to increase the your win rate, right? And when it comes to trading, we have time to take trades. Before I go over how to know what time frame to look for these zones on, really and truly, all time frames are independent, right? So you could really use any time frame, to be honest. All time frames are pretty independent. But if you want to trade with the trend, then aligning the time frames increases the probability, right? So this is how I would approach the market, right? What time frame you use is dependent on what trading style you're going with, right? So if you're going with swing trades, then obviously you look at the 4 hour time frame. And if you're going with day trades, then you'll be on the hour time frame or the 15 minute. 5 minute usually for scalping, right? For example, let's go over US 30. All right, so this is how I would look at the market to get a direct directional bias for day trading, right? Basically, when you're day trading, to increase your probability of winning, you want to go with the higher time frame trend, right? And most of the time, that's going to be your weekly and daily. If you could align your trades with the weekly and daily time frame, then there's a good chance you could catch a trade that's going to run very far, right? And it also increases the probability of your trade working out. So whenever I would approach the market, I would like to go to the weekly and daily time frame to just see what they're doing, right? And if I'm at a daily zone, the best trades could be found at daily zones. So if you're at a daily zone, supply and demand zone, then it's going to be a high probability of your trade working out, right? So whenever you approach a market, it's good to just have a look at the daily and weekly time frame just to see what direction they're trending, right? So in this scenario on US 30, we could see the weekly time frame is trending up, right? So we take that into consideration. Now, having the daily and the weekly in the same direction significantly increases the odds of the trade working out, and not only the trade working out, but it increases the odds of you having a significant risk to reward, right? So we could see the weekly is up, but but not all the times all the trades are going to be in the same direction, right? Now we're on the daily time frame on US 30, and we can see the daily trend is up, but we're currently in a pullback, right? So how do we know the daily trend is up? Well, for one, we could see this broken trend line. So basically, we had this pullback right here on the daily time frame, and then the market continued. So the daily time frame structure is like this, right? Impulse, pullback, and we could possibly have a next impulse. So structure wise, what we could understand from US 30, right? And all of this could be done in a few seconds, right? But I'm just going through the process so you can kind of see what the process is like when I'm doing like a top-down analysis, right? And most of the times, if not all of the analysis is done on the weekend, and then during the week is just to execute the trades. So from just analyzing US 30 using the higher time frame just to get a clear bias in the market, right? Because we use multiple time frame analysis to find the direction a lot of the times, and then once you have a clear direction, you could go down to the lower time frame and just look for supply and demand zones in that direction, right? So we understand that this is a pullback on the daily time frame. It could pull back to, this would be a daily demand zone, right? Drop, base, rally. So we don't want to be, once the market gets to this area, right? We don't want to be selling because we know this is demand and it could have, a reaction, right? So this is daily demand. So obviously we don't want to be selling when the market gets down there. So let's go to the 4-hour zone, right? The 4-hour zone. Okay, so we know the weekly is bullish, the daily is bullish, but also in a pullback, right? The 4-hour is bearish. The 4-hour is down. So in a scenario like this, once we know the 4-hour time frame is trending down, we don't buy at the 4-hour zones. We sell at the 4-hour zones because the 4-hour is trending down. We have to wait until the market gets to a daily zone before we could consider buying on the 4-hour time frame or at 4-hour zones. So the 4-hour trend is down, right? And these are mechanical rules that I follow, right? They're actually written down and all of that, but you should probably take note of this. Basically, right? This is what we call alignment with the higher time frame trend. Just knowing which time frames to do what, right? The weekly is bullish. The daily is bullish, but in a pullback. With that information alone, we could only buy at the daily zone, right? Now we're on the 4-hour right now, and we know, and let me write this down if this is easier, right? This is what we know so far. Just using multiple time frame analysis, right? Weekly up, daily up, right? For down. Now, with this information, because the 4-hour is down, we could only buy at 4-hour zones inside of daily zones. right? This is what we call nested zones. So this would be a 4-hour zone inside the daily zone, right? Now, if the 4-hour was up, okay, I'll just write this down. This is what we call alignment, right? It's just a way to increase your win rate. Now, this is how we would have approached it if and I know this might be a little advanced, but I'll still share it, right? Now, if this would have been a best case scenario, right? Now, if the weekly was up, the daily was up, and the 4-hour was up, then the market would have been aligned properly, right? And it would have made for a high probability trade, and you can buy at any 4-hour demand, right? So this is the major difference, right? The 4-hour is trending down, which means this is 4-hour demand right here, right? Now, the reason why we could still buy at this 4-hour demand, but the probability is a lot lower, right? Because the previous two higher time frames is trending up, and this 4-hour time frame is trending down. So in this scenario, I wouldn't buy the 4-hour demand. But had it been another scenario where the 4-hour trend was up and the daily and the weekly was up, then I would buy any 4-hour demand presented, right? Now, the only 4-hour demand that I would buy in this first scenario is a 4-hour demand that is inside of the daily demand or the weekly demand, which would be this one down here, right? Now, should the market get down there anytime in the future, I would confidently buy, right? Now, should the market start trending up on the 4-hour time frame, right? It break a high and it start trending up, then I would confidently buy because everything else would be aligned, right? Now, I actually have a PDF with all of these rules. I would drop it, but this is basically alignment, right? So a lot of traders who understand this would have like a high win rate when it comes to swing trading because they always trade in the direction of the trend. So basically, and this goes for any time frame, any 3 time frames, right? So these 3 time frames that I have right here is based on swing trading time frames. You also have scalping time frames, which would be, like the daily 4-hour, 1 hour, or the four, just three time frames, right? And that increases over time. So let's just go with what we have in front of us so far, right? So what we have in front of us so far is the 4-hour is bearish, right? And because the 4-hour is bearish, we only expect the market to turn once it gets to a daily zone, right? So we're kind of expecting the market to come down to this daily zone on US 30. And that could take a few days, right? So with that in mind, we could consider looking for an entry where we could get in on the trend, right? To head down to that daily zone. So, and just to check on the chart, just drop a 1 in the chart if you're following, right? Let me read the chart real quick. what if the 1 hour zone inside the 4 hour zone? What if the 1 hour zone inside a 4 hour consolidation zone? You would avoid zones inside of consolidation. Is there any indicator you could use to find imbalances? Yes, there are indicators you could use to find imbalances, but it's better to learn how to do it yourself because you could be way better than, an indicator. Or you could use an indicator to practice. So, for example, if you just search indicators and let me see if I can search one real quick. And you search like you search supply and demand zones or search you could search smart money concepts by Lux Algo. They have a nice indicator you could use, or order blocks finder, right? But I don't recommend using indicators. You could just practice how to do it yourself. But yeah. So we look for sells in the meantime. Yes, we look for sells on the lower time frame in the meantime, hopefully for the market to get down to the daily zones. I would think that it would have to touch the, well, yes, if you're swing trading and you're patient, you would wait for it to come down to the daily zone to look for buys, right? But, you know, once we understand the market and how the market moves, we could make decisions based on that understanding. Like, we know the weekly and the daily bullish, we should be buying at the daily zone, right? But the market may not get to the daily zone for the next 2 weeks for us to buy, but having the knowledge that is likely that it's going down to that daily zone, we could look for opportunities to counter trend the higher time frame to head down to that daily zone. So for this chart, we won't trade. We just wait for it to reach the daily zone. No, I would look for if we were to wait for the market to get down to this daily zone, we would be waiting a long time, right? And something to keep in mind, typically how the year works when it comes to stocks during this time of the year, because seasonality, I don't use seasonality, but what tends to happen around this time of the year, the market would drop, right? So that in November, because if you look at the news, you would see, oh, the stock market lost trillions of dollars, billions of dollars, right? This is normal for this time of the year because what people do and what rich people do, they would sell, right? So that in November they could buy. Usually in November, the market always makes a big run until the end of the year, and then around January it would have another sell-off. And for every presidential election, the market usually makes an all-time high. So I wouldn't be surprised if this continues to trend down, and sometime late October and November it bottoms out and then continues to trend up for the rest of the year, right? So, right. Okay, so having the knowledge that um the 4 is in a downtrend, daily is in an uptrend, we could only buy at daily zones, right? Let me see here. Right. So now we look to identify, just using the 4 hour time frame alone, where would be the best place to sell during on the 4 hour time frame, right? Now, This right here, and if you've joined the call late, then you probably won't understand. But this right here would be the novice area on the 4 hour time frame, right? So on the 4 hour time frame itself, we can't take, there's no supply here for us to take a trade. However, in this area right here, this rally base drop, this would be our sell zone, right? On this time frame. So if we had to sell, we would probably sell somewhere up here. Now this would be the proper zone to sell at, right? This rally base drop up here. But this was also a base on the 2 hour or the 3 hour or the 4 hour. So I also included this drop base drop, right? Because sometimes the market won't get all the way up here. So what I would do, I'd enter a trade here, and if it gets all the way up here, I just enter another trade. But I'm going to consider the entire zone for now, right? Okay. No, no, no. More than likely, the market is not going to get up there today, right? If it does, awesome. Now we're on the 1 hour. We're on a 1 hour time frame, and somebody did ask an important a question we're about to face, which was, should we yeah, what if the one JA asks, what if the 1 hour zone is inside the 4 hour consolidation, right? This is the 4 hour consolidation. Do we have any 1 hour zones in this area? No, right? And this is the thing about US 30, right? The 1 hour and the 4 hour zones are very, very, very good if you have them aligned with the trend. But the only thing is, they don't come around often. So whenever you see them, you have to take them, right? So in this scenario, right, this was the last 1 hour supply. Let's just ignore this 4 hour consolidation for a bit. And this was the last 1 hour supply, right? This drop base drop. Now this 1 hour supply was on US 30, NAS, and SPX last week. I did call it out on SPX last week, on the live session last week with Sway Markets. No, not this one. Let me just show you, because this was a trade that we took last week, right? And then we will get back to US 30. Right, so basically we had this drop base drop, we had the consolidation below, and then we had a sell limit right here that triggered, and the market, eventually, it took all week, but well, no, it took like 2 days to get to TP, right? But this is an example of a clean zone. Like, this zone was clean. Right now we don't have any clean zones on the 1 hour time frame. So I mean, there's nothing we could do, right? So let's go down. Now we're on the 5 minute, because from 5 minute, you're scalping from the 5 minute, right? So on the scalping time frame, you could get short moves. We know on a swing trading time frame, we don't really have anything much available right now, right? But let's just take this short-term perspective into consideration, and let's just look at what we have in front of us, right? So a lot of the times when I'm scalping, I'm looking to get into a move that started yesterday, right? Because a lot of the times the market would react to yesterday. Now, we know we're using supply and demand, so we want to get into where the banks are buying and selling. So I'm looking for a zone that was created yesterday to get into today, right? Sometimes you would have a zone that was created in the session and you could get in at the next session, which, does work a lot of the times. But if you if you want to approach the market from a perspective that you don't want to be in a rush and you want to find things in advance, then you could go off the zones that was created yesterday, right? So we're on a 5 minute time frame and we have two zones. We have this drop, base drop, and then we have this rally base drop, right? Now they both could work and they both could fail. That's the thing about trading. You don't know which zones are going to work and you don't know which zones are not going to work, right? So, but our job is to identify an area to enter the market that fits our trading plan and just execute. And then the market's job is to determine whether that is a winner or loser. But once we understand that our strategy has an edge and that over time it will be profitable, then that is what matters, right? Now, to keep things mechanical, what I do with my stop loss, I, I usually place my stop loss at around 30% of the zone, right? So this red line here is 30% the size of this zone. So, because a lot of the times, sometimes the market would come and tap the top of the zone and then drop. So I just give it that mechanical wiggle room. So I place my stop loss at the beginning of the zone, right? And instead of putting my stop loss right at the top of the zone, I would put it just above. That has saved so many trades. But yeah, but in this scenario, I'm not gonna use this zone could work, right? This 5 minute zone right here. Because we're going based off this this impulse down. We're agreeing to say that this was an impulse down, right? These are the supply zones. And all of this is the novice area, like in the lesson before, because you could see the difference in the price action, right? You could see how the price is, little volume, like the price is not the best for all of this. So we agree that this is the novice area and we agree that this is the supply and demand imbalance. No, this zone could work, but I don't like the location of the zone, right? Because the structure is good. We have a clean drop, base drop, right? And also, guys, these white candles are they help me identify the zones because these are 50% candles, right? These candles, the candles turn white whenever the body is less than 50% of the entire candle, which suggests that it's a basin candle, right? So if you want to use this indicator, I could do it without the indicator, but it just makes it pop, right? So this indicator is called less than 50% body candle. So if you want to use it, you could use it. I'm the only person that uses it, but you know, you might like it, you might not like it, but this is it right here, right? So you just type this in and you'd find it. I think it's by Alfonso. You would see it by Alfonso, right? But anyways, so this is a drop base drop, great structure, right? That indicator helps me identify basin candles. Basin candles, candles that suggest consolidation, right? It helps me identify, supply and demand zones quickly. But if you don't know how to use it or whatever, that's okay. But as I was saying, the structure of this area is great. Drop, base, drop, very good. Now, had this consolidation not be present next to this zone, for me it would have been A plus, right? But because it's right in the middle, practically in the middle of all of this consolidation, this all of this novice area, all of this balance price, that for me lowers the odds of it working, right? Which makes me decide, okay, I'm going to go with the zone above. And that's the thing. If you have two zones near each other, that increases the odds of the one above working out, right? So for this, I'm going to place a sell limit right here, a stop loss right here, and that's going to be my scalp for US 30, right? My target, I'm going to target the low, all right? So that's my US 30 scalp. I'm going to place this trade on an account and see how it works out. Now, let's see here. How long do you leave a pending trade for? Well, I would leave it for the entire day, like 24 hours, and then I would check back and reanalyze to see if the trade is still valid, right? Right, so I'm just gonna go on US 30. So this is how I would place the trade, right? I would go on US 30. We have the same zone right here, right? I would click sell, stop loss. No, normally I would risk 1%, but we're inside of that 4 hour consolidation, so I'm gonna be a little more conservative and just risk like 0.5%, right? All right. Okay. Take profit. Boom. All right. So we have this sell limit on the 5 minute time frame on US 30. No, this is a good trade, but we're gonna be conservative because this trade is inside of this 4 hour consolidation, right? Which lowers the probability, but from a 5 minute perspective, it's a good trade, right? Plus we have this supply zone right here. If the market can make it through this supply zone, then a lot of demand is gonna get used up, and this supply here should it should have, well, hopefully it has a good enough effect to at least secure something, right? And oh, I forgot, I didn't share the screen right here. Right. So I'm going to take a screenshot of this and post it in the Telegram chat. US 30 sell limit entry. Stop loss. So if you're on this live session, I'm considering doing this live session every day this week. So just hop on. Except on Wednesday. On Wednesday, I'm doing a live session with it's also free, but Wednesday I'm doing a live session with Sway Markets. So I'll send you the instructions to join. Entry, stop loss, take profits. Right. So now that we've identified our trade for US 30, how many setups do you take per day? I would set at least 5 pending orders, right? 5 pending orders is usually the limit. And then whenever a scalp presents itself, then we take it, right? So here's the thing. We did our analysis. This trade could work or it could fail, right? We don't know. Right now, we're paying the price to find out if the trade is going to work or not, right? Based on the 5-minute structure, usually if the 4-hour is bearish, once we have a bearish 4-hour and a bearish 1-hour, just like how we have the weekly and the daily bullish, and then we use the 4-hour as the entry. When it comes to scalping, you would use the 4-hour and the 1-hour as your higher time frames, right? And then the 15 and the 5-minute as your entry time frames, your lower time frames. So just from a scalping perspective, right? The 4-hour is bearish. The 1-hour is currently bearish, right? I don't like all of this consolidation over here. All of this consolidation brings down the probability of the trade a little bit, right? If there wasn't all this consolidation to the left, I would have gladly risked 1%. But having all this consolidation to the left lowers the probability, but we're still going to take the trade. Now, when it comes to scalping, and keep this in mind, right? Because I know a lot of you guys like to scalp. So if you want to increase the win rate of your scalping, just keep in mind you want to align the 4-hour and the 1-hour time frame. So if you want to know what direction you should scalp, if the 4-hour is bearish and the 1-hour is bearish, then you would look for sells on the 5-minute, 15-minute, 30-minute, right? On the minute time frames, you look for sells, and that would increase the probability of the trade, right? So in a scenario like this as well, to help with my psychology, the reason why I use limit orders instead of market execution is because market execution is very tempting for me, right? Market execution makes you chase a trade. If the market is moving up quickly or you see a big candle, you might want to jump in, right? Whenever I use market execution, I feel like I'm always running behind the trade. But whenever I use buy and sell limits, I feel like I'm trapping the market. Like I set the trap, the market comes to it and triggers the trap, right? And to help with because we've already done the work, right? You need to understand what's in your control and what's not in your control. What's your job, what's not your job. We've already done the work. We've already done the analysis. We've already executed the trade. Now is the market's job. Now is the market's turn. The market has to trigger the trade, and the market has to trigger the take profit or the stop loss. So on a average day, if this was if this was me trading on an average day, now that I've identified the trade and I've placed the trade, I have to leave the computer and then come back later to see what happens, right? Because staring at the computer is going to be very the market may try to seduce me into making a decision. I've already done all the logical thinking. I've already done the thinking. No, it's time to just allow the market to move. But if I stare at the market, sometimes the market may come close to the entry and then drop down, and then I'll feel like, okay, let me jump in here because I missed the move, you know? Or sometimes the trade may be looking like it's going good, and then I don't know, then you might have the feeling, okay, let's add some more to the trade, right? Now, one of the best psychological trading tips and habits you could use is not looking at the trade. Crazy enough, place the trade and go and do something with your life. Place the trade, go to work, place the trade, go make food, place the trade, go to the beach, and don't worry about the trade until the stop loss or the take profit is hit. It might sound weird, but it helps because what if the market just hits your stop loss and then it starts to go down? Now you're tempted to revenge trade, right? So we'll leave this and then we'll analyze something else. If you wanna drop a pair for us to analyze, you could drop, a pair. If you wanna ask a question, you could ask a question, right? Actually, I had some pairs already pre-analyzed. XAG, XA EuroCAD, ADUSD. EuroCAD, I'm pretty sure I sent this trade. Let's see. Alright, so I didn't execute this trade, but I believe I sent this trade in the signal chat. Let me check. EuroCAD. Right. Let me see if I sent it in the. Right, so this is EuroCAD, right? I sent this in the VIP chat last week. Basically, I was like, we selling right here, stop loss. So right here, I was like, new trade, EuroCAD, sell limit, entry, stop loss, take profit, 3R, right? So this was the setup right here. And then we could see this would have been the setup right here, right, for EuroCAD on the daily time frame. And then we have the 4-hour zone nested in the daily time frame, right? But this trade already played out. But this is just an example of the supply and demand zones working out, right? Would you repeat what you said about the 101 for being in the same? Okay, I'm gonna repeat that, right? So basically, we have what we call alignment when it comes to trading, right? Alignment simply means identifying. You have three time frames. You have your highest time frame based on what style you're trading. If it's swing, scalp, day trading, but if you were scalping, right? Your three time frames for scalping would be like, for it could be any three time frames, but in this example, we have your 4-hour. That would be a high time frame. Your 1-hour, middle time frame, right? And then 15 minutes or 5 minutes, right? And that's your entry time frame. Basically, you want the two time frames above to be in alignment in the same direction as your entry time frame. So you want the 4-hour to be trending down, right? Let's see, the 4-hour trending down and the 1-hour trending down to trade in the same direction, and you look for sells. And if the 5 or the 50 minute is trending down, then you look for sells on the entry time frame 5 and 15 minute, right? No, if actually, let me make this easier, right? Now you might wanna. I'm gonna show you all the scenarios, right? When it comes to alignment. Now, if the 4-hour is trending down and the 1-hour is trending down and the 15 minute is trending down, you have the stars aligned. So you enter sells on the 15-minute zone, right? Sell at any 15/5 minute zone, right? No, there's different scenarios. You could have, now let's do a scenario where the 4-hour, right, is trending down. The 1-hour is down, right? And then the 15/5 is up, right? You would encounter scenarios like this. You have the 15/5 up, your entry time frame is trending up, and then your two higher time frames is trending down, right? In a scenario like this, you cannot sell at any 5 or 15 minute zone. You could only sell at 5 or 15 minute zones inside of the 1-hour zone or the 1-hour zone. So in this scenario, right, you could only sell at the 5 or 15-minute zones inside of the 1 hour or the 4 hour zones. And that's what we call nested zones, right? So that's something to take into consideration, right? When it comes to finding a high probability zone. Yeah, that's what we call alignment. A lot of people don't know about it and they don't use it. They just enter any zone or any trade, right? But that is just a strategy to increase your win rate, right? To just increase the probabilities in your favor because the market is abundant. There are trades all the time, every day. No, you can't just be the addict that takes every trade. You don't want to be the market. You don't want to be the person that comes to the market looking to take every trade. It's like you want the market to be like, listen, here's here's all the trades we have, and then you pick the best one, right? Because you're going to meet a lot of trades that fit your strategy, but you want to pick the best one that's available at the moment, right? No, when it comes to US 30 and indices, these are some of the best assets to trade on a lower time frame because a lot of the times US 30, NAS 100, SPX 500 would have a 5 or 15-minute zone almost every day that is high quality that you could execute on, right? When the market is, when the market conditions is pretty good. Let's see if NAS 100 has anything. Alright, so NAS reacting to this zone right here. And some days you don't have to take every trade, you know what I mean? As long as you only take good trades, it's okay to miss trades because eventually once you get a trade, it's going to be a good trade, right? Alright, so SPX 500, we have this. Oh, this is going to be on the 30-minute. Alright, so I have this supply zone right here on the 30-minute. Should the market get to this zone, I would expect a very good trade, right? Now, why is this zone high quality? And that's the thing, you would mark up your zones and just wait for the market to get there. But basically, on the 30-minute, we have a very clean drop, base drop, right? The structure of this zone is high quality. Why? Because we have a nice base, looks good, right? Nice and nice tight base, right? The move away, two candles, two extended range candles, basically candles that didn't pull back, right? And then since the creation of this, the market has created a novice area below, as you can see, and it has not returned to this zone since. Now, this is the highest quality zone on this time frame, nearest to the price, right? So should the market get to this area, I would confidently risk 1%. Because of how everything is set up, the market may not get there, but based on the information we have, this would be an ideal area to confidently take a trade based on how everything is set up. We have the daily and the 4 hour in a downtrend. The 30 minute. This is on the 30-minute time frame, right? We have a supply imbalance. Below we have the novice area. So should the market get there this week? If the market gets there this week, then we have a nice trade for a 1 to 6, right? The imbalance created from this zone is 6 times the size of the zone. Well, actually, it's more than 6. It's 8, right? So the size of the zone compared to the move away from the zone, the move away from the zone is 8 times the size of the zone, which puts the odds in our favor, right? So, this would be the best trade that I would have available to take this week. So if the market somehow makes its way up to this area this week, then I would be very happy, right? If it doesn't, then we could do about it. But I just wanted you to see this so that you see an exam. Not every day and not all the time the stars would align for a good trade, but this is an ideal trade, right? I've been afraid of indices except J225 because I don't understand how they. I mean, the market, from my perspective, all markets move the same. They just move from supply to demand and in the middle, right? I don't use, patterns, just any pattern. I only use supply and demand because I believe that that is how the market really works. The market works based on the amount of buying and selling that's going on at specific price levels, not just, based on patterns, right? I mean, patterns has an edge. Patterns has their odds, their probabilities, but I like to. It's better for me to view the market from a logical perspective. Just to understand, to have a sense of understanding why something might happen. You know, and every strategy works as long as you make profit, as long as you're profitable, as long as over a series of trades you're making money. Every strategy works. Yeah, you just have to find a strategy that works for you, right? Like, I have a couple strategies. Sometimes I use them, sometimes I don't. But it's good to have the knowledge. I'm a place and most likely, weird enough, um I have what you call the 11 a.m. and 2 p.m. strategy. Basically, it's just a time-based strategy that I've realized that most of the time the market reverses at those specific times. So I wouldn't be surprised if the market plays around, right, until 11, and then at exactly 11 or between 11 and 12, our supply zone gets hit and the market drops, right? So let's just mark off 11. What time is it? 10. Okay, 11. So this is 11 and this is 11 to 12, right? So I don't know why, but a lot of the times, most of my scalp trades is triggered at 11. And if it doesn't trigger at 11, then it would trigger at 2 easternly, right? So I'll just highlight this area to see, if that happens to be, right? So we're still waiting on US 30. Let's have a look at gold. So let me break down gold real quick because I have this I'm looking to buy in this area on gold, right? And I'll explain why. Now on gold, taken from a higher time frame perspective, let's start on the weekly. Right? The weekly on gold is bullish. We have a rally, base rally, novice area, right? But it's still bullish. So we know the weekly up. And let's put this here, just weekly up, right? This is gold. Now the daily, on the daily time frame we have on gold. Let me just clean this up a bit. Right, so on the daily time frame, right, on gold, we have, starting from the bottom here, we have the low, a high, a low, high, right? So we could say the daily is bullish on gold. We have demand, the market already reacted. We have another, this would be 4 hour, daily 4 hour demand right here, a drop base rally. We also had this demand right here, but I don't have it marked off because it's in the middle of the range. I would prefer to take zones that is lower in the range or outside of the range. When I say the range, I mean the novice area. So it's in the middle of the range, this daily demand. So I'm not gonna mark it, but I'm gonna keep an eye on it. This right here was also demand. However, this demand isn't qualified for me, right? Meaning that the move away needs to be 2 to 3 times the size of the zone. And it's in this rally base rally, you can see the zone was only 1 times the size of the zone, right? So that would lower the quality of the zone. But anyways, we have the daily bullish and the weekly bullish. That we could agree on. Now the 4 hour time frame is where it gets a little technical, right? Now, if you've been following gold, we took this sell right here on gold over the last few weeks because this was the 4 hour reversal, right? So the 4 hour time frame basically wasn't a downtrend, right? We had this rally base drop, we had the novice area below, and we sell, right? Now, because the market came into this supply zone multiple times, this is also a 1 hour supply zone. Multiple times, it came into the zone, more than 50% of the zone multiple times. That basically says to us that most of the orders has been, removed at that zone, right? So that's something we want to take into consideration. So when it comes to the 4 hour, should the market start trending down from here, then we would consider an alignment at the 4 hour zones inside of the daily zone, which would be, the daily zone would be all the way down here. So we would look to enter at 4 hour inside of the daily using the alignment rules, right? Now, just based on the recent price action, even though this is consolidation, we could kind of see we have high, low, high, lower, low, and then higher, high, right? So this right here, this structure right here suggests an uptrend on the 4 hour time frame, because we know uptrends are higher highs and higher lows, downtrends are lower lows and lower highs, right? So on the 4 hour, just on this micro consolidation, we have this, right? So what does that tell us? It's not the best, but it does tell us that the daily, weekly, and the 4 hour is somewhat in an uptrend, right? Well, the 4 hour is in consolidation. You could say it's consolidation because we have this. So it didn't break this high. So it's more like consolidation slash downtrend slash mini uptrend. But let's just go with this leg, right, on the 4 hour. If we had to place a trade, assuming the 4 hour is bullish based on this leg, then we would ask ourselves, where's the best place to buy? And that's why I have this 15-minute zone right here, right? Now it may or may not work, but this zone is good enough to at least get a reaction, right? Because we have a clean drop base rally, a good structure, a good location, right? So we also have the daily and the weekly bullish to add to our confluence, right? But with the 4 hour in consolidation, that would be a cause for concern. So there would be trades where the trade isn't perfect, so we would risk half the normal amount, and then there would be trades where everything is perfect, so we risk the full amount, right? So in this scenario right here, I would risk like 0.5%, right? 0.5% because the 4 hour is in consolidation, and 0.5% can still go a long way, right? Obviously, if the market gets closer to the entry, I would send a signal, but the market is still far. Today is Monday. Usually Monday, you don't expect much. And this week is there will be little news this week. Not a lot of news this week. So we won't expect those fast moves in the market. Those trending moves. We expect the market to be a little more calm this week, because if you look at Forex Factory, there isn't a ton of news, right? Your USD, Euro CAD, Euro, Euro. This AUD USD, right? That was sent last week. It was a late entry, but it still worked out. Basically, the idea was we had a rally based drop. This was daily supply right here in the middle, the novice area on the daily time frame. The market came up, tapped into the daily supply zone, and once it started reacting, I saw this trade a little late. That's why the entry was here. Had I seen the trade earlier, then we would have entered at this 4-hour supply inside of the daily supply zone, right? Keep in mind, nested zones is simply a zone inside of a high quality zone inside of a higher time frame zone that increases the odds of the trade working out, right? So this would have been the entire daily zone up here, but then this would be the 4-hour zone, this rally based drop that created this move. This is the 4-hour zone inside of that daily zone, right? Some of the best trades comes from 4-hour zones that's inside of daily zones. Like for example, right here we have this gray area right here is a daily zone, right? This 4-hour zone, this is a 4-hour zone inside of the daily zone, right? Now, the difference between this zone and this zone up here is this daily supply is outside of the novice area, right? It's outside of all of this consolidation, which significantly increases the odds of the trade working out. Now, this zone, it could still work, but I would take it at half the risk simply because it's next to consolidation, right? But it is a qualified zone. It's next to consolidation. If the consolidation was directly next to it, I definitely would not have taken the zone. For example, right? You could see for this base rally, all of this is the consolidation, but the main consolidation is over here, right? This area. Had this zone been on this side, directly next to all of this consolidation, I would never consider taking the trade, right? Because you could see all the zones next to this consolidation, the market just went past it. No, this zone right here, this is the daily. Let's go on the daily time frame and see what it looks like. Right, so on the daily time frame, we have this base rally, two extended range candles to move away from the zone, right? Basically two full candles that didn't pull back. And then we have that zone. So let's see the daily time frame. Now, a lot of the times, what I like to do is set up a trade that looks like it might not even activate. Sometimes you would pick an area where you feel like the market would not even get to, also increases the odds of the trade working out, because more than likely you're picking an area at a significant supply and demand zone that you even have doubts that the market could even get there, which would suggest that it would be hard for the market to get there, which would suggest that you're expecting so much sellers to be in the market that the buyers doesn't even have the strength to get the market to the zone, right? So for example, we have this, and that's I have a lot of examples of that, but an example of this would be, okay, we have this daily zone, we want to enter here, the market could come here, tap it, and the trade could blast off, right? No, because this zone is inside of all of this consolidation, is likely that the market could go deeper into the zone, right? So in this scenario, what I would do, I would take the zone like this. So we have this drop base rally, right? And this would be the zone for me right here, right? So just minimizing the daily zone a bit. Right, so this would be the daily zone for me. So then I would place my buy limit right here. And I would place this buy limit right here. I'll probably send it as a signal. And this would be and the only thing about trading in the higher time frame is you have to not care about the trade. You have to place the trade and leave it for days and not even care about it. And how do you do that? Well, whatever you're risking needs to not be significant enough to make you emotional, right? Whatever you're risking needs to not be significant enough to make you want to, if it is in drawdown, to make you want to close the trade, or even if it's in a lot of profit, to make you want to close the trade, right? So it should be an amount where you're following your risk management plan, but it doesn't affect you. That's the key to set and forget, right? Set the trade and forget about it, because you could really trade any time frame. Is whether or not you have if you're somebody who stares at the charts and stares at the numbers all the time, you probably won't be able to do it. But if you're somebody who could place the trade, go live their life for the next 23 hours, and then come back and just see, okay, what's the update? Then, this would be it, right? So I would place this buy limit there. Would this recording be sent in the Telegram chat? I'll upload it on YouTube and send it on the Telegram chat. Since you asked, JA, whoever JA is, right? So I mean, you could take a screenshot of this if you want to consider taking the trade, but I'll also send it in the Telegram chat. Right, so what time is it? 10:53. Let's see if US 30. Nah, US 30 ain't activate yet, but we're expecting US 30 to activate between 11 and 10. I mean 11 and 12, my bad. 11 to 12, we're gonna see if US 30 activates. But yeah, I think we'll keep it. We're not gonna keep the live session too long today. This has already been 2 hours, so I'll probably wait like 5 minutes after 11 to see if it triggers at 11, and then we'll hop off, and we'll be in the chats, right? You could always hit me up in the chats. the Telegram chat to see what's up. So we have 4 minutes until 11. So if you want to ask any questions in the meantime, or you want me to analyze a specific currency pair in the meantime, you could go ahead. Can I share? Hi, can share GBP JPY analysis. Nope, just want to say it was very helpful. Well, happy to hear that it was helpful. Let's have a look at GBP JPY. Now, before we dive into GBP JPY, this was the best place to enter. Previously, the market already reacted to it. This 30-minute supply zone created on Wednesday, September 4th, activated on the 5th, right? But let's do a top-down analysis. Okay, so you can see I already have this little note for myself. Monthly in control, weekly down, right? Let's see what the monthly says. Okay, so I probably wrote monthly in control because the market came up, and this was probably done a long time ago. The market came up, it tapped into GBP JPY monthly supply, right? So that tells us the higher time frame is likely to be bearish. And a lot of people, they don't zoom out to see what's going on, so they wouldn't know that GBP JPY just hit a monthly supply, right? So everyone that was probably buying this trend up, that kept buying when it was all the way up here, assumed that it would continue up, not knowing that at this price level, the market hit monthly supply, right? So once the market hits monthly supply, weekly demand was removed, and an uptrend could be considered supply and demand also being respected. So weekly demand, this was rally-based rally, tap into monthly supply, boom, weekly demand removed, right? So monthly down, weekly down. That's what we know, right? Just based on what we analyze, the monthly time frame is down, the weekly time frame is down. All right, so this would be weekly supply on GBP JPY. So right, all time frames, right? So this would be weekly supply. So So, let's say GBP JPY was up in this weekly supply. I would execute a sell because the month is monthly and weekly supply at this area, right? So we did our higher time frame. Well, almost. Now we're on the daily time frame, right? This is what we call top-down analysis. Because you have to do your analysis, your top-down analysis to get the direction and the bias. Because this is what you have to understand. There's analysis to find out what's going on in the market, where the market is likely to go. And once you understand the narrative of the market, the last analysis you need to do is, okay, where would I enter? Where's the next available entry, right? Because you can't just have a bias that the market is going in a particular direction and just enter. After you know what direction you want to trade in, next you have to look for where does my strategy tell me the nearest available entry is, right? So we know monthly down, weekly down, daily down, right? Because we have drop base, drop base, drop base, drop. This is daily supply, right? This down here was daily demand, but we know we're in a downtrend, so we're not looking to buy, right? But we could see the market reacted to this daily demand right here, right? Right here. The market reacted to this daily demand. So we have daily supply up here, but the market is not there. However, we know monthly, weekly, and daily is down. So most likely we look for sells, right? So we're on the 4 hour right now. On the 4 hour time frame, we have this would be the daily, but this would be the 4 hour. So I'll just remove the daily, just I'll remove the daily and the weekly from the 4 hour to keep the chart clean, right? All right. So okay, let me change this. And then daily. Is the daily down? Anyways, so now we have the 4 hour, right? Just looking at this big impulse right here, the market is reacting to this 4 hour supply right here, right? Now, on the 4 hour time frame, we had before all of this, we had the weekly down, the daily down, and the 4 hour was up, right? Just ignore what's happening right now. But when the market was here, the 4 hour was up because the 4 hour was trending up. The 4 hour removed this initial supply right here. So having the weekly down, the daily down, and the 4 hour up, if you was paying attention in the previous lesson, let me ask you a question, right? Where would you look for sells? If just taking the alignment of the weekly, daily, and 4 hour, if the weekly is down, the daily is down, and the 4 hour is up, where would you look for sells? Let me see who took notes from the last lesson. I'm gonna give you a few seconds to answer. If nobody answered, then I'll answer, right? But if somebody answer, I will be very proud. That means that person would have probably been taking very very important notes on alignment because this is exactly what I mentioned. This is exactly what I mentioned earlier. No, it wouldn't be an 1 hour, right? Now, okay, the weekly down, the 4 hour, the daily down, the 4 hour up, right? Which means you cannot sell at 4 hour zones. Yeah, well, you cannot sell at 4 hour by itself. You have to sell at the daily zone, right? Because you have to go one time frame high. Whenever one time frame is out of alignment, you go one time frame higher. So because the weekly down, the daily down, and the 4 hour up, the 4 hour is not down. So then you have to go to the daily time frame, right? So you would sell at the daily time frame, or you would only sell at the 4 hour time frame inside of the daily time frame, right? And it takes practice to remember. So yes, we had this 4 hour zone right here, but we probably would not have taken it if we were using the alignment rules, because we would have only been able to take a 4 hour zone that would have been inside of the daily zone. So we would have used this 4 hour zone instead, but the market didn't get there, reacted to this zone, right? Okay, so now that the market reacted to this zone, this 4 hour zone, and it started a 4 hour downtrend, right? Right here, we have this trend line broke, the market making lower lows. Now we're in alignment, right? Because now the 4 hour is down, the daily is down, right? So now we look for sells on 4 hour zones, all right? At the nearest 4 hour zone, we look for sell. Now it would be, all this would be rally base drop, right? So this would be a 4 hour zone, all right? Now obviously it's next to all of this consolidation, but the alignment gives it higher odds, but I would risk half a percent, right? Because the reason why the zone looks like this is because we have two zones right here. We have this zone, this drop, base drop, and then we have this zone, this drop, base drop, that's right next to each other. So we just combine them, right? Now the highest probability entry would be this right here, right? This would be the highest probability entry, because we have this 4 hour supply that is outside of the consolidation, right? This is the consolidation, this right here. This is 4 hour supply outside of the consolidation. This is an example of a ideal trading setup. This is the setup where you would have no problem risking 1%, because it meets more all of the requirements practically, right? But it may or may not get there, and that's what it is. So that's what you would that's how you would approach it from a swing trading perspective. Entering off the 4 hour, we know 4 hour supply here, lower quality but higher quality up here, right? Now with the mindset that, okay, we're going into a day trading, scalping point of view of the market, right? So now our alignment would be 4 hour, 1 hour, right? And then entry on the minute time frames, like 30 minutes, 15, 5, right? So this was the optimal entry from a day trading perspective. Now let's assume this didn't happen yet and the market was here. We would have been like, okay, we know the 4 hour is down, we know the 1 hour is down, so we could look for an entry on the 15 or the 30 minute, right? So on the 30 minute, we would have been like, okay, we have a nice drop, base drop right here that is outside of the consolidation, because the consolidation would have been down here, right? This would have been the consolidation, and we would have identified that all the time frames is practically bearish. So this would have been our set, and we would have set this trade because it would have met all our requirements, and we would have taken this trade. And one thing I like to do, right, whenever I find a trade that I didn't take, or whenever I'm back testing the week, I like to look at the time, like, okay, I would look at the time the zone was created. The zone was created at 11, and then the day ended at like 5 o'clock, right? So I would have looked at this and I would have been like, okay, we have a supply zone right here. The market dropped, it consolidated. Would I have taken this trade? Well, at the time the zone was created, the imbalance, right, would have been about 1 to 2, right? The move away from the zone at this time in the market was 1 to 2, right? Which was enough to qualify the trade. Now, this is Wednesday, right? Let's say Thursday at 8 a.m. If I had looked at this trade, then we would have seen, okay, the market came down 5 times the size of the zone, the supply zone, 4 times, right? So we have a 4 4x move away. We have consolidation below the zone. All the time frames are aligned bearish. Then we could confidently set a sell limit right here and move on with our lives, right? Now this trade would have activated. Hopefully we would have not been present when it activated and it would have gone into profit, because a lot of people would see the market coming towards their entry like this with this strong candle, and then they would get intimidated and not take the trade, right? Because they feel like the market coming in too strong. It doesn't matter how strong the market comes into your zone. If you have a qualified zone, the market would just bounce right off, right? Sometimes even the stronger the market comes into your zone, the more confident you could be, because you know a lot of people is gonna jump ship because of how impulsive the market is coming into the zone, right? So it's always good to identify where would have been the best area to place a trade. Now, looking at the current data that we have, the 4 hour is still bearish, 1 hour is still bearish, all of the above time frames still bearish. So obviously we continue to look for sells on the lower time frame, right? And on the 30-minute, there isn't any quality zones. Let's see on the 15-minute, because we have this impulse. This was news. This was news on Friday. So this zone is not quality, right? Because it's wiki, it's big, it's not quality. So you would need to let some time pass and allow the market to develop new areas, right? On the 5-minute time frame for this impulse right here, we have a drop base drop, right here. We have a drop base drop, and we actually took a trade on Friday that looks very similar to this. We'll go over it, right? And then we have this rally base drop on the 5-minute, right? So on the 5-minute time frame, we identified 2 areas where we could get a possible entry, taking into consideration that the 1 hour and the 4 hour is in alignment for sells, right? So when it comes to GBP JPY, these are the 2 areas I would consider selling, right? Why? Because we could see a significant supply and demand imbalance here. And if you look at this price, right, compared to this price, you could see a huge difference, because look at how wicky and slow the price moves here. This suggests the novice area consolidation. This suggests, there's equal number of buyers and sellers, right? So if the market can make its way up here where we where the evidence suggests to us that there are more sellers than buyers, then we would, we would confidently execute sells on the 5 minute, for scalps based on that knowledge, right? Now remember this, because last week we took this scalp right here, which is very similar to the trade we just analyzed. The idea here was pretty much based on, this was daily 4 hour demand on USD CHF, right? The market was in daily demand. And we had unemployment news created these big candles that kind of shook up the market, but we were scalping, right? So the the thought that I had was, we're in daily demand, the market is likely to go up. Where is the best place to buy? We're already in daily demand, right? Just based on the recent structure of the market and the volume and everything that's going on. So if you look in the public chart, you'd actually see the signal was sent last week. So we looked at the last impulsive move, right? Which was this move right here. From 8, created at 8:43 and came up to high at 9, right? So we had demand zones in the middle, but we looked at the origin of the move, which was this demand right here on the 1 minute time frame, taking into consideration we're in daily demand and all of that. And this signal was sent last week, if you was paying attention. I'll pull it up. Stop loss was 30% of the zone right here, right? And then the market triggered the zone, came up over the weekend and eventually made its way much higher, right? So, that just kind of shows us the power of supply and demand. So if you look in the group chat, if you look in the Telegram chat, you would see, this trade. Okay, so the trade, we're at 11, right? And it didn't trigger yet. So then the next time I would expect it to trigger would be 2, because based on historical data, the market tends to trigger the supply and demand zone at 11 and 2, right? So if it doesn't make it there at 11, then at 2 o'clock I would expect it. Not that the time matters, because I'm not going to be looking at this anyway, because I've already placed the trade. So I'm just gonna, once we get off the charts, I'm just gonna go to the park, probably have something to eat, probably work out, probably ride, in the skate park, ride my skateboard, and do other stuff with the day. Once we're done trading, once your trade is set up, you just trust the process and you go along with your day, and you come back the next time you're scheduled to analyze the market, right? So we'll leave it at that. Have a good day, guys, and just follow your trading plan, practice your psychology, and get better. You can always hit me up if you need anything or if you need any advice, right? So have a good day, and thanks for hopping on. For sure, George. George, you can send me a DM. Yeah, it was a great session, guys. Ladies and gentlemen. You're welcome.